Today we are going to discuss the structure of Indian banking. This structure can be categorized into two classes, organized sector and unorganized sector. Organized sector is that which is under the direct control and supervision of Reserve Bank of India. As we know, Reserve Bank of India is the apex institution of our country which guides, regulates and controls the entire financial system. Under the heading Reserve Bank of India, we have scheduled banks, non-scheduled banks, differentiated banks. Under the heading scheduled banks, we have commercial banks, cooperative banks and development banks. And under the heading differentiated banks, we have payment bank and small finance bank. We will discuss these points one by one. So, first of all, scheduled banks. Scheduled banks are those which have been included in the second schedule of the Reserve Bank of India Act 1934. Scheduled banks, they get special privileges as compared to non-scheduled banks, such as they receive refinance facilities from the RBI. Under the heading scheduled banks, we have first point commercial banks, cooperative banks and development banks. Under the heading commercial banks, first of all we will discuss the meaning of commercial banks. Commercial banks, they are the profit based financial institutions which accept deposits, grant loans and they provide other financial services to the general public, to the business, to the companies in order to ensure the sustainable growth of our economy. Under this heading commercial banks, we will discuss the points public sector banks, private sector banks, foreign banks and regional rural banks. Let us discuss these points one by one. Under the heading public sector banks, let us discuss the meaning of public sector banks first. These are the banks which are owned and controlled by the government. It means greater part of the equity of such banks is held by the government. These banks, they are of two types, SBI and its subsidiaries and other nationalized banks. As we know, in 2016, government approved the merger of 5 associate banks with the SBI, and in 2019, our finance minister announced the consolidation of 10 public sector banks into 4 mega state owned banks. Private sector banks. Private sector banks are those where greater part of equity is held by private shareholders and not by the government. These banks, they can be categorized into two classes, old private sector banks and new private sector banks. New private sector banks such as we have ICICI Bank, HDFC Bank, IDFC First Bank, etc. Now, foreign banks. Foreign banks are those banks which are incorporated outside India. They have their head office in a foreign country, but they have their branches or representative offices in our country. Thus, these banks, they operate through physical branches or through their representative offices. Next point, we have regional rural banks. Regional rural banks are scheduled banks and these are created to serve the rural areas with basic banking and financial services. These banks basically work for the development of agriculture, trade, industry and for other productive areas in the rural sector of our economy. These banks are regulated by National Bank for Agriculture and Rural Development. Some examples of regional rural banks are Punjab Grameen Bank, Chhattisgarh Rajya Grameen Bank, Nagaland Rural Bank, etc. Next point is cooperative banks. These are the banks which are organized on a cooperative basis. These are owned and operated by the members for a common purpose. These can be classified into 3 categories. At the apex level, we have state cooperative bank in each state. At the district level, we have central cooperative banks, and at the village level, there are primary agricultural credit societies. Next heading is development banks. These are specialized banks, specialized financial institutions, and these banks, they provide medium and long term finance to the agricultural sector, to the industrial sector, and to the infrastructure sector. They provide finance to both private and public sectors. The main objective of these banks is to promote industrial growth, agricultural growth, and to finance housing and infrastructural projects. These banks can be classified into 4 categories: industrial development banks such as IFCI, IDBI, agricultural development banks, export import development banks, and housing development banks. Let us now study non-scheduled banks. Non-scheduled banks are those which are not included in the second schedule of Reserve Bank of India Act. These banks, they do not get refinance facilities from the RBI. Next category is differentiated banks. Differentiated banks, they are also called niche banks. These are the banks which serve the needs of a specific segment of the population. In 2015, Reserve Bank of India granted approval to 11 entities for setting up payment banks and small finance banks. Thus, these banks, they are of 2 types: payment banks and small finance banks. Next point is payment banks. So, payment banks, these are a new form of banks which provide payment remittance services to small businesses, to low income households, and other unorganized sectors. These banks, they accept demand deposits, they can issue ATM debit cards, but they cannot issue credit cards and they cannot lend money to the general public. Some famous examples are Airtel Payment Bank, Paytm Payment Bank, etc. Okay, let us now discuss small finance banks. Small finance banks, they are also a type of niche banks in our country. These banks were basically established to provide financial inclusion to the sections of the economy which are unserved by the large banks, such as micro and small industries, marginal farmers, etc. Small finance banks, they can undertake basic banking activities, that is accepting deposits and lending money. Existing microfinance institutions, non-banking financial companies, and local area banks, they can apply to become small finance banks. Some important examples of small finance banks are Ujjivan Small Finance Bank, AU Small Finance Bank, Utkarsh Small Finance Bank, etc. Let us now discuss unorganized sector of the Indian banking. This sector can be classified into 2 categories: indigenous bankers and money lenders. Indigenous bankers, they are basically the local bankers. They are individuals or private firms which perform the basic banking functions. Money lenders, they include large farmers, merchants, village shopkeepers, etc. Money lenders, they use their own funds for lending purposes and they charge very high rate of interest. So, I hope these points are clear to all of you.